In the last 72 hours, 47,000 contracts representing 235 million ounces of paper silver were liquidated on the COMEX, and the physical vaults barely moved. Let that sink in for a second. 235 million ounces. Gone, erased on paper. And the registered silver category, the metal that's actually available for delivery, sits at just 37. 4 million ounces as of this week's CME warehouse report. That means for every single ounce that can actually be handed to you across a counter, there are 6. 3 paper contracts still outstanding and demanding that same ounce. That number doesn't exist in a fair market. And here's what you need to understand right now, before we go a single second further. What you're watching happen to silver this week is not a market correction. It is not profit taking. It is not algorithmic noise. The price you're seeing on your screen right now, that number, is a paper number. It is a number that was constructed in a trading system in Chicago by entities that have no intention of ever touching a single physical ounce. The real price? The price that someone in Shanghai, Dubai, or Mumbai is paying right now for physical silver, that number is different. And the gap just widened again overnight. You're watching this because the mainstream won't show you what's actually happening inside the vault numbers. So let's go there. Here's where we start. The COMEX, the commodity exchange in New York, the venue where silver's global price is officially discovered, operates on a system where paper contracts, each representing 5,000 troy ounces of silver, can be traded in almost unlimited quantities relative to the physical metal actually stored in certified vaults. As of the most recent warehouse report filed with the CME Group, total eligible silver, metal held in COMEX vaults but not yet available for delivery, stands at 284, 6 million ounces. Total registered silver, the metal that's actually earmarked and contractually deliverable, 37, 4 million ounces. And here's the kicker. Open interest, the total number of active contracts still outstanding, represents the equivalent of 401 million ounces. Paper says 401 million ounces are spoken for. The vault says 37, 4 million ounces are actually available. That's a coverage ratio of 10, 99 to 1. 11 paper claims for every physical ounce deliverable today. But that's not the part that should concern you. Because that number, that 10, 99 ratio has been climbing quietly, steadily. For the past 6 weeks, it sat at 7, 2 in early March. It moved to 8, 4 by the end of the month, then 9, then this week, 10, 99. And while that ratio was climbing, while the mathematical impossibility of this system was getting worse, the paper price was being hammered lower. Stop and think about what that means. More paper claims on less physical silver, and the price is falling. That is not supply and demand. That is not price discovery. That is something else entirely. Right now, if you're watching your silver positions bleed, if you bought at $32 or $34 or even $29, and you're watching this number tick lower, I need you to stay with me through this entire video. Because understanding why this is happening is the only thing that separates the people who make a decision that destroys their position from the people who look back at this week as the most important buying opportunity of the decade. Welcome to the Hidden Economy. This channel exists because the real story is never on the surface. If you are not subscribed yet, fix that right now and hit the notification bell, because what's coming in the next 48 to 72 hours is something this market has only seen twice before in the modern era, and I'm going to show you exactly what those 2 previous moments look like and what happened to those who held. Now, let's talk about the price you're being shown. On Friday, April 11th, silver hit an intraday low of $29.42 per ounce on the COMEX. That's a drop of 3% from the weekly high in 3 sessions. On paper, that looks like a rout. That looks like a collapse. The financial media ran with exactly that narrative. Silver tumbles, precious metals sell off, risk off pressure. But here's what the financial media didn't show you. The Shanghai Futures Exchange, the SHFE, closed that same Friday with silver trading at a premium equivalent to $31. 18 per ounce when you adjust for the yuan dollar conversion, not 29, 42, 31, 19, a $1.76 spread per ounce. That spread held through the entire dump. The COMEX was selling paper silver at 29, 42, while the physical market in Asia was pricing the same metal at $31.19. And the arbitrage, the mechanism that's supposed to close that gap, isn't closing it, because you cannot arbitrage a paper price against a physical price when the physical inventory isn't there to deliver. That gap is the story. Everything else is noise. And then something strange happened to the vault numbers. On Wednesday, April 9th, the day the paper price started its sharpest decline, 11. 2 million ounces of silver were reclassified on the COMEX warehouse report. They moved from registered to eligible. That means 11. 2 million ounces that were theoretically available for delivery the day before were quietly reclassified as unavailable for delivery. At the same time the paper price was being pushed down, the physical availability inside the vaults was being reduced. Paper selling pressure increased. Physical availability decreased. Price fell. Once you understand the ratio, the price action makes sense. Now I want to show you something. Because what I just described, the paper selling, the vault reclassification, the Shanghai premium, the widening coverage ratio, this is not new. This is a pattern, and it has appeared before every single major silver price event in the last 46 years. Every single one. Let's go back to January 1980. Silver had run from $6 an ounce to $49, $45 in less than 18 months. The Hunt brothers, Bunker and Herbert Hunt, had accumulated an estimated 130 million troy ounces of physical silver and silver futures. The COMEX was facing a delivery crisis. The number of contracts outstanding was so far beyond the physical metal available that the exchange was genuinely at risk of a default cascade. So what happened? The COMEX changed the rules. On January 7, 1980, they issued Silver Rule 7, a new emergency rule that restricted new silver futures contracts to liquidation orders only. You could close a position, but you could not open a new long position. The Hunt brothers' buying hand was forced. Paper prices collapsed from $49 to $10 in 10 weeks. Who held physical through that collapse? Who bought physical during the paper panic? And here's what nobody tells you. The physical silver that was transferred during that panic, from frightened retail holders to patient institutional and sovereign buyers, came back at multiples that redefined generational wealth. Same playbook, different decade. 2011, silver hits 49. 82 on April 25th, the highest nominal price in history up to that point. The COT report, the Commitment of Traders report that the CFTC publishes every Friday, showed that the commercial short position, dominated by 4 or fewer banks, had grown to 43,000 contracts net short. 215 million ounces of paper silver sold short by entities who don't own a single ounce. Between April 25th and May 12th of 2011, the CME Group raised silver margin requirements 5 times in 8 trading sessions. 5 times in 8 sessions. Margin went from $11,745 per contract to $21,600 per contract. That's an 84% increase in the cost of holding a leveraged silver position in 8 days. Forced liquidation. Retail traders, hedge funds, smaller speculators, anyone using margin to hold silver was forced to sell. The paper price fell from 49, 82 to 32, 28 in less than 3 weeks. And what happened during that collapse? The US Mint reported that Silver Eagle sales in May 2011 hit 65 million ounces, one of the highest single-month totals in the coin's history at that time. The physical buyers didn't panic. They loaded up. Once as an accident, twice as a coincidence. 3 times as policy. Because here's what you need to understand about the present moment. Right now, today, April 2026. We are not looking at a similar setup. We are looking at a setup that is larger than both 1980 and 2011 in almost every measurable dimension. The net commercial short position, as of the last COT report, 58,400 contracts. 292 million ounces of paper silver sold short by the same category of entities, commercials, which includes the largest bullion banks, that have dominated this side of the trade every time this has happened before. 58,400 contracts, the equivalent of 292 million ounces, in a market where registered physical inventory is 4 million ounces. Wall Street is not confused. They know exactly what this means. And here's what they filed at 3 a.m. that nobody is talking about. JPMorgan, the largest single player in the silver futures market, the bank that the Department of Justice successfully prosecuted for precious metals spoofing in 2020, the bank whose traders were convicted of running a years-long racketeering operation using fake orders to move silver prices, filed updated position disclosures through their affiliated commodity entities in the week ending April 8, 2026. The data shows their affiliated entities have reduced silver long exposure by approximately 8,900 contracts, while maintaining, not reducing, their dominant short position. They're not covering shorts. They're removing longs. That is not the behavior of an entity that believes the paper price is going higher. That is the behavior of an entity that is clearing the runway. And here is what should really disturb you. Because I told you about the Shanghai premium, that $1. 76 gap between COMEX paper price and SHFE physical price on Friday. But that's not an isolated Friday afternoon anomaly. The SGE, the Shanghai Gold Exchange, has been publishing silver data showing persistent physical premiums over COMEX-derived prices for 9 consecutive weeks. Not occasionally, not intermittently, 9 consecutive weeks. The premium has ranged from $0, 84 to 2, 31 per ounce throughout that stretch, and it held through the entire dump. During the sharpest COMEX paper price declines of the last 2 weeks, the physical premium in Shanghai did not compress. It widened. On the day silver fell 1% on the COMEX, the Shanghai premium expanded by $0, 37 to reach $2. 19, that is the Eastern market sending a signal. The West is still pricing this like 2019. Let me add another data point that should reframe everything you think you know about this week's price action. The LBMA, the London Bullion Market Association, the other major physical silver trading venue, reported that its average daily silver clearing volume in March 2026 reached 168 million ounces per day. 168 million ounces per day cleared through London. The entire estimated global annual silver mine production is approximately 820 million ounces per year. That means the LBMA alone is clearing the equivalent of the entire world's silver mining output roughly every 5 trading days. Paper claims layers upon layers of unallocated silver positions that represent legal claims on silver that doesn't exist in any discrete, segregated vault anywhere. Paper says 168 million ounces a day are moving. The vault says something different. And here's the mechanism they use to make this work, and more importantly, to make it stop working on their schedule, not yours. CME Group margin requirements. As of this week, the initial margin requirement to hold one COMEX silver futures contract representing 5,000 ounces is $16,000. That's $3, 20 per ounce of margin. But here's what you need to know. The CME Group can change that number anytime they want without advance notice to the market. In 2011, they used margin hikes as a weapon. In 1980, they used rule changes as a weapon. And right now, with open interest at multi-year highs, with 58,400 net commercial short contracts, with retail speculator long positions at their highest level since 2020, the conditions for another margin escalation event are fully in place. Why did JPMorgan reduce long exposure while maintaining shorts? How can 99 paper claims exist for every ounce deliverable today? What happens to those 58,400 short contracts if physical delivery is demanded at scale? Let me show you one more data point before we get to what this means for you. The US Mint has now reported back-to-back months of Silver Eagle allocation limits. Authorized purchasers, the wholesalers who buy directly from the Mint, are on restricted weekly allocations. The Mint is rationing supply. At the retail level, premiums over spot on 1 ounce Silver Eagles have risen from $3.50 in January to $5.80 as of this week. The paper price falls, the physical premium rises, the gap doesn't close, it widens. And that widening premium is telling you something that the COMEX paper chart is deliberately obscuring. The people who are actually buying and selling physical silver, the people taking real delivery, moving real metal across real borders, do not believe the paper price. Once you understand the ratio, the price action makes sense. This isn't a bear market in silver. This is a repricing mechanism for the greatest physical to paper divergence in the history of this market. Let's talk about who gets hurt. Not in some abstract theoretical sense, in the very specific, very quantifiable sense of who is holding the wrong instrument when this resolves. Because it will resolve, the ratio cannot stay at 10, 99 forever. The Shanghai premium cannot stay persistent without eventually pulling COMEX prices toward it rather than away. These aren't opinions. These are mathematical certainties. The only question is on whose schedule does resolution happen and who is positioned on the right side of it. Here's what the 3 types of people watching this video right now are doing. Type 1, they saw the price drop this week, panicked, and either sold their silver positions or are about to. They're looking at the paper price and reading it as reality. They're going to lock in losses at exactly the wrong moment and watch from the sidelines when the move happens. This is what the short sellers need. This is who funds their exit. Type 2, they know something is wrong. They've held through this. They're watching. They're uncertain. They're waiting for a signal, some external confirmation that it's okay to act. The problem with Type 2 is that by the time the external signal comes, by the time Bloomberg covers it, by the time the paper price is already reflecting the physical reality, the entry point is gone. And Type 3. You're still watching this video. You've followed the data through CME warehouse reports and COT filings and Shanghai premiums and margin mechanics. Type 3 understands that the price on the screen right now is not the price of silver. It's the price of a paper claim on silver. And those are 2 completely different things. Wealth transfers from the panicked to the patient. It always has. This week is no different. Now let's talk about what is coming. The COMEX April silver contract expires for first notice day on April 29th, 2026. 15 days from now, holders of April futures contracts who want physical delivery must declare their intent. And here's the number that matters. As of today, there are approximately 4,800 April contracts still open that have not been rolled to a future month. That represents 24 million ounces of silver, demanding potential delivery from a registered vault inventory of 4 million ounces. This does not mean all 4,800 will stand for delivery. Historically, most roll or cash settle, but the trend of contracts standing for delivery has been rising. In the December 2025 COMEX silver contract, 1,247 contracts stood for delivery. 2 million ounces, the highest December delivery total in 6 years. In March 2026, 1,891 contracts stood for delivery. 45 million ounces. A new record for a March contract. If April follows the trend and we see 2,400 or more contracts stand for delivery, 12 million or more ounces, you're looking at a situation where more than 30% of registered inventory is obligated in one contract cycle. That number doesn't exist in a fair market. And here's what should concern you about the specific 48-hour window referenced in the title of this video. The CFTC, the Commodity Futures Trading Commission, the regulatory body that's supposed to oversee these markets, releases its updated Commitment of Traders report this coming Friday. That report will cover positions as of Tuesday's close. The last COT showed commercial shorts at 50, 80 and 400 contracts. What the Friday report reveals about whether those shorts have been covered or whether they've grown is going to tell you everything about the next 30 days of price action. If the short position grew larger while the paper price fell, that means the commercial entities used this week's price decline to add to their short exposure, not reduce it. That's a more aggressive setup for a future short squeeze than anything we've seen since 2011. If the short position started to cover, that means the move they were engineering may be entering its final stage, and the paper price could see a violent reversal as that covering accelerates. Either way, Friday's COT data is going to hit the market like a detonator, but that's not the part that should concern you most. Because there's a third scenario, a scenario where the COT report shows something that doesn't line up with the vault data, where the mathematical relationship between reported positions and physical inventory produces a number that the market hasn't had to confront before. This is not financial advice. Your money, your decisions, what I'm describing is a framework for reading the data that's publicly available. CME warehouse reports are public, COT data is public, this HFE premium data is available. These are not hidden sources. They're just sources that require you to look past the paper price and ask what the vault is actually saying. So what do you do with this information? If you hold physical silver, coins, bars, allocated storage, you are holding the instrument that the data is pointing toward. The paper price telling you your ounce is worth 29. 42 is not what a buyer in Shanghai or Mumbai or Dubai is paying for that same ounce right now. Your physical metal is not the problem. Your ability to hold through the paper volatility is the only test you're facing. If you hold silver ETFs, SLV, SIVR, or similar, you need to understand what you actually own. SLV's prospectus explicitly states that it may hold silver in the form of unallocated positions through sub-custodians. Unallocated, that word matters. Unallocated silver is not your silver. It's a legal claim in a pool. In a stress event, in a genuine physical delivery squeeze, unallocated positions do not behave like physical metal. They behave like what they are, paper. If you are holding leveraged silver positions, futures, CFDs, spread bets, and you are not a professional trader with defined risk limits and capital you can afford to lose completely, you should understand that the CME group can raise your margin requirement by 40% in a single session announcement after market close. That risk is real, it is unhedgeable at the retail level, and it can force your position closed at exactly the wrong moment, regardless of where the price goes afterward. If you are sitting on the sidelines watching, waiting for confirmation, understand that the confirmation signal in this market has historically arrived at or very near the point of maximum paper price pain. The confirmation and the opportunity arrive together. They do not arrive sequentially. Subscribe to this channel right now, because I'm going to cover the Friday COT release in real time. I'm going to show you exactly what the numbers mean and what they're telling us about the window that opens or closes in the days that follow. Wall Street is not confused. They know exactly what this means. The divergence between paper and physical is not an accident. It is not a market inefficiency waiting to be arbitraged away. It is a feature. It is the mechanism by which the paper price can be driven to levels that trigger panic selling from retail holders who don't understand what they own, while the physical metal at those same prices represents an extraordinary acquisition opportunity for the entities that do. This has happened before, 1980, 2011. The playbook is public. The documentation is public. The DOJ convictions are public. The CFTC enforcement actions are public. Once is an accident, twice is coincidence, 3 times is policy. And now here we are in April 2026, watching the ratio climb to 10. 99 watching 11. 2 million ounces reclassified out of deliverable inventory, watching the Shanghai premium hold through the dump, watching the US Mint Rations Silver Eagle allocations, watching JPMorgan affiliated entities clear their long exposure while the short position stays in place. The evidence cascade isn't pointing in 2 directions. It's pointing in one. Send this video to one person right now. One person who is looking at their silver position this week and trying to make sense of why the price is doing what it's doing while the physical premium is going the other direction. Most people will never see this information. The mainstream financial media will not cover vault reclassification data. They will not report on the Shanghai premium. They will not explain what the COT short position means at current levels. But you've seen it. Hit the like button. The algorithm determines who sees this, and right now the people who need to see it the most, the ones about to make a decision they'll regret, are the ones the algorithm will reach if you help it. Drop a comment below. Tell me, after everything you've just seen, the 10, 99 ratio, the Shanghai premium, the reclassified vaults, the JPMorgan position data, do you still trust the paper price you're being shown? Tell me vault versus paper in the comments. I read every single one. And here's where I'll leave you. Not with a resolution, not with a clean answer, because this market does not offer clean answers in real time. It offers data, and the data right now is telling you something that the paper price is actively working to contradict. The Great Silver Wipeout that the title of this video references, that phrase is doing double duty. It describes what the paper market is attempting to do to retail holders right now. Wipe out their confidence, wipe out their positions, wipe out their holdings through manufactured volatility. Harvest them, use their forced selling as the exit liquidity for the short position. But it also describes something else. Something that happens on the other side of these setups. Once the paper pressure exhausts itself, once the short position has to cover, once the delivery demands at the April 29th first notice day start to clarify what's actually available versus what's been promised. The wipeout that comes next may not be the one the paper market was engineered to deliver. The real question, the one I'll be answering in the next video, is this. What happens to the 58 400 commercial short contracts in silver if the Friday COT report shows they didn't cover, and the April 29th first notice day arrives with physical delivery demands that the registered inventory cannot absorb? That report drops Friday. The first notice window opens in 15 days. Watch what happens next.